Welcome to the Deep Dive. Today we're taking a deep dive into a company that powers millions of homes and is, well, really leading the charge in renewable energy. NextEra Energy, Inc., or NEE. We've got a pretty comprehensive investment analysis here, and it poses a really fascinating question for you. Does NEE actually qualify as a wonderful company? You know, the kind you'd feel comfortable owning for decades?
It's a critical question, absolutely. And we're going to unpack its unique dual business model. We'll look at its competitive advantages and even dig into some, frankly, surprising challenges lurking beneath the surface. Our mission here is really to extract the most important insights so you can quickly get a handle on what makes this company tick.
Okay, let's dig into this business then. The analysis describes NEE as having a dual engine structure. That sounds interesting. What exactly does that mean, and why is it so strategic for them?
Right, so what's fascinating here is how NEE has masterfully combined two really different businesses. Engine 1, Florida Power and Light, FPL. This is the bedrock. It's the largest electric utility in the U.S., serving over 6 million accounts. That's about 12 million people in high-growth Florida. It's a classic rate-regulated monopoly, earning stable returns on its infrastructure investments. Just for context, FPL reported huge gross revenues in 2024, $17.02 billion, and it generates something like 65-70% of NEE's consolidated earnings. So immense financial stability there.
Okay, so FPL is the stable giant, the foundation. What about the second engine, NEER?
That's NextEra Energy Resources, or NEER. And this is the high growth arm. NEER is actually the world's largest generator of renewable energy from wind and solar, and a global leader in battery storage, too. They develop and operate these huge clean energy projects, and they sell the power under long-term fixed price contracts. Power purchase agreements, or PPAs.
PPAs, right.
Yeah, typically 15, 20 years. So that locks in revenue and really reduces price volatility. NEER's operating portfolio is just vast, over 37 gigawatts of capacity.
So it's this mix of stability from FPL and growth from NEER. The analysis also talks about the simplicity and endurance of this model. What makes it so enduring, especially now?
That's a great question. I mean, how relevant will this business be in the future? Well, NEE provides electricity. It's essential. Demand is inelastic. People need it. And if you connect this to the bigger picture, it's perfectly aligned with two incredibly powerful secular trends.
Okay, I like that.
First, population growth and electrification. FTL operates in Florida, a rapidly growing state. That means a steady increase in customers and, crucially, demand for grid investment. Second, the global decarbonization imperative. We're talking a multi-trillion-dollar global energy transition. That's a multi-decade tailwind for NEER. Plus, you've got government policy support, like the U.S. Inflation Reduction Act, and just strong customer demand for clean energy. So the assessment is this model is highly likely to stay relevant, profitable, and growing for the next 10 to 20 years, probably well beyond.
Okay, that makes sense. But any successful long-term business needs a moat, right? A competitive fortress. What are NEE's main economic moats?
Yeah, absolutely. And NEV benefits from two powerful, distinct moats, one for each engine. For FPL, its moat is being a regulated monopoly. It has a state-sanctioned monopoly in Florida. The sheer capital costs, the regulatory hurdles. It's basically impossible for a competitor to challenge FPL. This gives FPL pricing power through rate cases with the Florida Public Service Commission, the FPSC. And historically, they've allowed FPL to earn pretty attractive returns.
And for NEER, the growth engine.
NEER's moat is all about scale-based cost advantages. This is textbook stuff, really. Their sheer size gives them huge advantages, like superior procurement. Their massive buying power for turbines, panels, batteries gets them favorable pricing, way better than smaller players. Then there's industry-leading operational efficiency. Their O&M costs, operating maintenance, are apparently top decile.
Top decile. How?
Standardized processes, remote control centers, proprietary data analytics, something called NextEra Analytics. It just means lower operating costs than rivals. And finally, unmatched development and financing. They have deep in-house expertise, and the financial strength of the parent company lets them develop projects faster, cheaper, and finance them at a lower cost of capital.
That sounds powerful on paper, but how do we actually see these moats in action? What's the tangible proof?
Oh, it's very tangible. You see FPL's moat in things like its successful petitions for rate increases, like their 2025 proposal to seek a $1.6 billion base rate hike for 2026. That's regulated pricing power funding grid modernization. NEER's moat. Look at its massive project backlog. Over 25 gigawatts of signed new projects as of early 2025. and a total development pipeline of around 300 gigawatts.
Wow, 300 gigawatts.
Yeah, these are legally binding contracts won in competitive bidding. It proves their superior cost structure lets them win deals others just can't.
So what's the trajectory here? Are these moats getting stronger or weaker?
The analysis concludes they're both widening. The energy transition. It demands large, complex, capital-intensive projects, exactly what NEER is built for. That strengthens its scale advantages, raises barriers to entry. And for FPL, Florida's strong growth naturally expands its regulated rate base. More customers, more investment needed. The company plans to invest something like $120 billion over the next 4 years alone. That's just going to make both moats even stronger. And there's this symbiotic thing happening too. FPL's stability and its strong A-rated credit directly lower the cost of capital for NEER's growth projects. Ah, I see. So FPL helps NEER borrow cheaper.
Exactly. FPL de-risks and cheapens NEER's funding, which in turn provides that high-growth profile utility investors love. It's a combined moat that's really unique and hard to copy.
Okay, now this is where the analysis gets really interesting for me. It includes a Scuttlebutt simulation looking at customer and employee perspectives. And it apparently reveals some glaring contradictions. Let's start with the customers. Right, and this is flagged as a major red flag in the analysis. Because objectively, FPL's operational metrics are superb. I mean, 59% better service reliability than the national average. They avoided 2.7 million customer outages in 2024 using smart grid tech. They win national reliability awards. They are objectively excellent at keeping the lights on.
But the customer sentiment tells a completely different story.
Abysmal. Just abysmal. Data from Comparably shows FPL with a net promoter score and NPS of negative 86.
Minus 86. That's incredibly low.
It's shockingly low. It means 92% of respondents are classified as detractors. People actively dislike the company. It's described as one of the worst scores for any major public-facing company. And public reviews for their competitive retail arm, NextEra Energy services, are just full of accusations. Deceptive practices, scam pricing, profoundly poor customer service. It's really bad.
So you have this huge disconnect, top-tier performance, bottom-tier perception. What does that actually mean for the company, especially a regulated one like FPL?
Well, it presents a significant latent risk. For a regulated monopoly like FPL, profitability is tied to a politically appointed commission. If you have widespread, intense customer anger, like a NEC 86 NPS, suggests that creates real political risk.
Because angry voters complain to politicians.
Exactly. Angry constituents complain to elected officials, who can then pressure the regulators. Over time, this could turn Florida's constructive regulatory environment into an adversarial one, and that could mean smaller rate increases or even rejected ones, which directly hurts FPL's profitability and its ability to grow that rate base.
Which then impacts NEER.
Right. It cripples FPL as the cash cow and hurts its ability to provide that low-cost funding for NEER. It threatens the whole corporate strategy. The analysis really stresses this isn't some soft HR issue. It's a tangible long-term threat to the company's moat and its future earning power.
Wow. Okay. And what about the employee side? Is the internal culture also a potential risk?
It's similarly mixed, actually. Compensation and benefits generally cited as positives. But there are persistent, serious complaints on platforms like Glassdoor, Reddit. You know the places.
What kind of complaints?
Things like poor work-life balance, horrible and top-heavy management structures, rampant nepotism, and just a generally toxic work environment. There was one quote from a former senior systems engineer saying, if you do a good job, your reward is doing other people's work. And HR is, quote, useless.
Ouch. How does that impact the business, especially one built on efficiency?
It's a direct strategic risk. ADE's whole competitive advantage is built on operational excellence, doing things better, faster, cheaper.
Yeah.
That excellence comes from its people, over 16,000 of them. So if you have a perceived toxic culture, high turnover, poor management, that threatens your ability to attract and keep the elite talent you need. If your best engineers and project managers leave, your O&M costs could rise, project execution could suffer, and NEER's cost advantage. It could start to erode.
Okay, let's pivot to leadership then. John Ketchum took over as CEO in early 2022. What's his philosophy? How's he allocating capital?
Well, he's a 20-year company veteran, so he definitely has a deep operational understanding. His philosophy seems very clear, long-term, owner-oriented. It's focused on operational superiority, designing, building, financing, operating projects better than anyone else. He really emphasizes rigorous financial discipline and leveraging that scale to lead the U.S. decarbonization effort. And his consistency in reaffirming long-term financial targets, even when things get tricky, shows a commitment to predictable execution.
So how does that translate into capital allocation decisions? Where does the money go?
It's very disciplined and heavily growth-oriented. Reinvestment CapEx is absolutely dominant. NEE has deployed over $230 billion since 2001.
$230 billion. Wow.
Yeah. And they plan another $120 billion between 2024 and 2027. About 65% of that goes to high-growth NEER, the rest to stable FPL. It's a very clear strategy. Compound capital in your areas of strength. Acquisitions, M&A seem logical, strategic. Things like Gulf Power, which expanded FPL's footprint, or bolt-ons like Florida City Gas. Credit agencies note an aggressive acquisition appetite, but the deals look strategically sound.
And shareholder returns.
Dividends are the main vehicle here. They have an amazing 31-year streak of consecutive dividend increases, and management's targeting around 10% annual dividend per share growth through at least 2026. That's supported by a sustainable payout ratio, 60-79% of adjusted earnings. What's notably absent? Share buybacks.
No buybacks. Interesting.
Right. Instead, NEE is a net issuer of shares. They frequently use equity units to help fund those massive growth investments.
So putting it all together, what does this rationality test tell us about management? Are they being sensible stewards of capital?
It suggests management is highly rational and consistent. They're not hoarding cash. They're not making crazy acquisitions outside their expertise. They are aggressively putting capital to work in their highest return opportunities. Choosing to issue equity for growth rather than over-leveraging or skipping good projects is actually seen as disciplined long-term thinking. It's kind of empire building, yes, but focused and strategic, aimed at growing long-term per share value.
Given all that investment and the structure, how financially resilient is NEE? How dependable are the earnings?
NEE is a very reliable earnings generator. They've got a long track record of strong adjusted earnings per share growth, and they're guiding for 6-8% annual growth through 2027. That's pretty consistent. And that consistency comes from that hybrid model regulated utility returns from FPL, plus those long-term contracted revenues from NEER. Now, GAAP net income can bounce around a bit because of accounting stuff, but the underlying economic engine is stable and very profitable. EBITDA margins have averaged over 50% recently.
Let's dig into some key financial ratios the analysis highlighted. What do they reveal about profitability, cash generation, and the debt situation?
Sure. The analysis flags a few key ones. First, return on invested capital, ROIC. It's moderate, averaging around 4.7% over the last 5 years, 4.8% in 2024. Now, that's not the high teens you might see with, say, a software company often called Wonderful, but that's kind of the point here.
How so?
Its wonderfulness isn't about super high margins. It's about its almost unique ability to invest tens of billions every year at a positive, even if modest, spread above its cost of capital. They can consistently deploy huge amounts of money profitably.
Okay, what about cash flow?
Right, free cash flow, FCF conversion. This is crucial and might surprise some people. NEE's free cash flow is consistently and significantly negative.
Negative free cash flow. That sounds bad.
It looks bad on the surface, but it's deliberate. In 2024, net income was almost $7 billion, but FCF was negative $11.5 billion. Why? Because their capital spending, their CapEx program, is just massive. It dwarfs cash from operations. This isn't a broken business. It's a company in a historic investment phase. They're building long-lived assets that will generate predictable cash flows for decades. It's like prepaying for future profits.
Got it. And the balance sheet. All this spending must mean a lot of debt.
It does. The company carries significant debt to fund this expansion. Net debt to EBITDA is elevated, around 5.7x. Debt to equity is substantial at 1.32. But here's the key thing. Despite this leverage, NE maintains strong investment-grade credit ratings, AOB or Bay1, from all the major agencies.
Why is that with that much debt?
Because the rating agencies see the debt as manageable. Given a high quality and predictability of NE's underlying cash flows from FPL and those NEER contracts, it ensures they keep access to capital markets at favorable rates. So yes, the financial fortress is leveraged, but its foundations are considered solid by the people whose job it is to be skeptical.
Okay, so bringing it all together, what does this mean for the stock price today? Where does it stand from a valuation perspective?
Well, looking at the multiples, it's interesting. The current trailing PE ratio is around 26.5x. Now, that might still sound high, but it's a pretty significant discount compared to its 5-year average, which was closer to 37.8x. Price to free cash flow, as we discussed, isn't really useful because FCF is negative, but price to operating cash flow is about 11.1x, and that's also a meaningful discount to its 5-year average of 14.9x.
So the judgment in the analysis, is this a good time to potentially get in?
Based on the deep dive into its quality, its widening moats, disciplined management, the judgment is that the current price represents a fair to potentially attractive entry point for owning a piece of this, well, arguably wonderful company. The thinking is that near-term worries, maybe rising rates, maybe economic slowdown fears, are giving investors a rare chance to buy a premier long-term compounder at a reasonable price. And the old saying goes, it's often better to buy a wonderful company at a fair price than a fair company at a wonderful price. This might be one of those times.
Makes sense. Looking forward, what's the primary engine driving NE's future earnings? What's the big growth story here?
The biggest driver, without a doubt, is that huge, multi-decade, multi-trillion-dollar structural shift to decarbonize and electrify the U.S. economy. Think about all the new electricity demand coming from data centers, AI, electric vehicles, industrial processes switching to electricity. EE, through NEER, is the undisputed leader in this transition. That massive 300 GW development pipeline we mentioned, it positions them perfectly to capture a huge chunk of this secular growth for many, many years.
It sounds almost unstoppable, but every investment has risks. What are the permanent impairment risks? What could truly derail this company long term?
Yeah, despite the powerful story, there are genuine long-term risks. Number one is probably adverse regulatory change in Florida. It's that latent time bomb connected to customer dissatisfaction. If the constructive environment sours, possibly because of public anger, it could permanently impair FPL's earning power, and that cripples its ability to fund NEER, striking right at the heart of the whole strategy.
Okay, what else?
Sustained high cost of capital. Needs growth, especially NEER's, relies heavily on borrowing. If interest rates stay permanently higher, it could squeeze or even eliminate the profitable spreads on new renewable projects. That would stall NEER's growth and strain the leveraged balance sheet. And then there's technological obsolescence. NE leads in wind, solar, batteries today. But what if there's a breakthrough in, say, nuclear fusion or some radically better battery chemistry? That could erode NEER's cost advantages faster than anyone expects.
So given all of that, what's the market's general view of NE? And how does this deep dive analysis maybe offer a more contrarian take?
Well, the prevailing market narrative seems to be that NE is the best house in a good neighborhood. It's widely seen as a high-quality, premium-price leader with a unique growth profile. You see that reflected in the moderate buy consensus from Wall Street analysts. They appreciate the quality, but are maybe a bit cautious on the valuation. But this analysis leads to a more nuanced, maybe even contrarian view in a couple of key ways. First, underestimated fragility on the regulatory side. The consensus seems to underestimate that latent risk from the terrible customer satisfaction data, that Next 86 NPS. It gets dismissed as a soft issue. This analysis concludes it's actually a hard, quantifiable leading indicator of significant political and regulatory risk. The view of FPL as an unbreachable fortress might be, frankly, complacent.
Interesting. And the second point?
Underestimated durability of NEER's moat. Conversely, the consensus might be underestimating just how durable NEER's scale-based cost advantage is. As the energy transition demands bigger, more complex projects, the barriers to entry for smaller competitors actually get higher. This could let NEER capture an even larger share of the economic profits than the market currently expects.
So the contrarian angle is, the big risk, regulatory, might be bigger than people think, but the big advantage, NEER scale, might also be stronger and last longer than people think. That's quite a tension. Okay, let's try to synthesize this. Can you summarize the core investment thesis? The bull case, the main reason someone would want to own NEE?
Sure. The key reasons boiled out of these. One, it's the dominant market leader in a massive secular growth trend, the U.S. energy transition, multi-decade, multi-trillion-dollar opportunity. Two, it has powerful, widening moats, that dual advantage, regulated monopoly in high-growth Florida, FPL, plus unparalleled scale-based cost advantages in renewables, and both seem to be strengthening. Three, disciplined, shareholder-oriented management, a proven team rationally deploying huge amounts of capital into high-conviction projects while delivering a secure, rapidly growing dividend targeting that 10% annual growth. And four, potentially an attractive entry point. The current valuation seems to offer a chance to buy in at a meaningful discount to its own recent history, providing maybe a margin of safety for long-term investors.
And the bear case, the counter thesis. What are the biggest worries, the reasons to stay away?
The main counter-arguments are pretty serious. First, that latent regulatory time bomb. The abysmal customer satisfaction at FPL is a significant, maybe underappreciated risk. Political backlash could lead to a hostile regulatory environment in Florida, hitting the core profit engine. Second, the high wire act of leverage. That heavy debt load and reliance on external capital make the business very vulnerable if interest rates stay high. It could kill project economics and stop growth dead in its tracks. Third, execution risk and cultural strain. Investing $120 billion is a massive undertaking. There's significant execution risk, and it could be made worse by those cultural issues potentially hurting operational excellence. And finally, no margin for error. Even after the recent pullback, the valuation isn't exactly cheap. It demands near flawless execution for years. There's little room for disappointment.
Okay, last question, the red team challenge. What's the most compelling argument for how this investment could turn into a catastrophic long-term mistake?
The absolute worst-case scenario. The ultimate nightmare scenario happens if the core bull assumption that all this massive reinvestment leads to a corresponding increase in high-quality future cash flows simply proves false. And the path to that failure looks like a kind of pincer movement. On one side, NEER's growth engine sputters. Maybe competition gets fierce and drives down returns. Maybe the cost of capital stays permanently high and kills the economics. Or maybe those cultural issues cause talent drain and they lose their cost advantage. And then simultaneously on the other side, FPL's latent regulatory risk explodes into a full-blown crisis. Public anger boils over, Florida regulators turn hostile, rate increases get denied or slashed, squeezing FPL's margins and starving it of capital.
So NEER isn't growing and FPL can't fund it.
Exactly. In that scenario, NEE is left drowning in debt, having spent over $100 billion on assets that are now underperforming and low return. The whole growth utility story collapses, that 10% dividend growth dream evaporates, and the market brutally re-rates NEE as just a stagnant, over-leveraged, maybe poorly run utility. That leads to a permanent destruction of value. That's the ultimate bear case. And importantly, the analysis suggests the potential seeds of that scenario are visible in the data we have today.
Wow, what a deep dive indeed. We've gone from dual engines and widening moats right through to some really challenging customer issues and a pretty sobering bear case. It's clear this is much more complex than just your average utility.
Absolutely. We've seen this remarkable blend of stability and growth ambition, but also how these underlying operational and regulatory risks could genuinely challenge that impressive trajectory. It's definitely a fascinating company to analyze.
So for you, the listener, as you mull over everything we've discussed about NextEra Energy, here's a thought to maybe chew on. Given that stark contrast between FPL's objective top-tier reliability metrics and those truly abysmal customer satisfaction scores, what specific actions could management realistically take to diffuse that latent regulatory time bomb without compromising the operational excellence that defines them? And maybe how quickly do you think that kind of perception problem could actually turn into real regulatory trouble?